Welcome to the InterMarket Analysis Weekly Video Update, where I go through a number of different areas in the market arena that look outside of the S&P 500. We look at valuation, both historically, looking forward. I look at growth versus value, and value had a pretty good week, but growth is still hanging in there, looking strong. We look at some other markets that we usually don't look at all that much. We break down positive and negative things as well, and we take some long-term looks at some different charts. So this is being prepared for Monday, July 7th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. First of all, I'll go through the area on valuation, growth versus value, and we look at inflation. Everybody seems to be talking about that, but for right now, it seems to be under control. Some other markets, as I mentioned, and I look at the 11 sectors that make up the S&P, different indexes outside of the S&P 500, and some correlations between the markets, long-term trends, as I mentioned, and then a positive and negative list. And we're seeing this continued offensive rather than defensive approach to the market right now, even though value had a pretty good week. Okay, first of all, we look at valuation. We are still expensive. We've been expensive for quite a while now. We're coming in well over the 20 level for the PE ratio, but we are getting bumped up a little bit here to about 4,300 with the upper end of the PE ratio looking historically. But you can see we spend a lot of time above the red dashed line. And when folks say the market is expensive, that's true. But we can be overextended for years at a time. All right, this also just looks historically, different events that have happened and what the valuations were. Then the Shiller PE ratio, this looks at a smooth approach using earnings over a spread out period of time, 10 years, and it's still coming in quite high too at 38.31 here. Again, the median and the mean really hasn't changed. It's between 16 and 17. So we're over double what the average is for this particular way of measuring valuation. And this was a chart I ran across throughout the week, and I wanted to show it here. The Shiller PE ratio, that's this chart that I just showed here, a reliable long-term gauge. Well, it's been overextended for a while. It's pricier than it's been in all but 4% of the time. And it goes back to lows. Now, really, we set the low later than that, but it's going off the October 2002 low here. And we were already above 20, but still below 30 at that point. March 2009, that's when we bottomed coming out of the great financial crisis. The Shiller PE ratio was quite a bit lower at about 12 at that point. And then this is after the COVID crash, March of 2020, Liberation Day. We fell back, but we never came back under 30. And then what it is currently, well up over 35. So if you look at the market using this approach, you're like, man, we're looking pretty expensive right now. And you're right about that. But there are periods of time when the market doesn't seem to care about that. They don't mind buying high with the hope of selling even higher. All right, then we look at the forward PE ratios put out by Edward Yardeni, and we're still coming in hot here with the mega cap 8 is how he breaks that down, coming in at 29. The S&P, we're getting close to that 22 level. We're at 21.9. And then we did see a nice little week with the mid caps and the small caps. They're a little bit above 15, coming in at 15.9 with the mid caps and 15.2 with the small caps. Then we go through and look at value versus growth. And here we just look at growth all by itself. Recent golden cross, setting new all-time highs here with the pure growth index. That's positive. And we are positive with value. It had a pretty good week. You can see this little spike up here. That was the 1st of July. And we saw growth actually go down about 1% that day for the S&P, and value was up about 1%. And that could just be some initial month and quarter beginnings buying, just having folks setting up portfolios for the entire month and quarter. But we want to watch that. If we see the market continuing to get more defensive, that's usually a warning sign. It's not really happening. It did happen on July 1st, but since then, growth has come back and has pretty much assumed a leadership role, even though value had a good week. And then we look at the ratios between growth and value. You can see where we came down, but then we bumped up in Thursday's session. We are in an uptrend, and growth is clearly outperforming value. Here's an inverted version of that same ratio, showing how value continues to underperform growth. We look at some ETFs. Growth is really shining here compared to value. Value is really undershining here compared to growth. And then the indexes looking pretty solid here with the growth to value ratio. Here's the value to growth ratio going down. Then we look at the growth ETF versus the value ETF. Still not really breaking out to new highs, but it's still holding up quite well this way. And this shows how value continues to underperform growth. And we break it out here, the mid caps, where the mid caps are finally starting to break out of this little range. Can that continue? And we're still holding up fairly well when we look at mid-cap growth to value. Small cap growth to value still looking pretty strong. Did fall down under its 50-day moving average with the ratio, but the small caps are trying to make a little bit of an up thrust here. And then this is the one that applies to the S&P 500, and I show it in the daily videos. Recent golden cross, not really breaking out to a new high yet, but holding up quite well. So when you take all the growth and value charts that we look at, growth is still outperforming. But we keep a close eye on that. And I go through a lot of those ratios, even in the daily videos, because we can sometimes get some clues if the market is starting to turn more defensive. Then inflation. Here's the monthly chart. We just finished July. Now June. We're starting to go into July. We are going up with a long-term trend here with the CRB index, which could potentially be inflationary. And we are seeing a bit of a pickup between the inflation-deflation ratio here. Longer term, we're still above the moving average. So we want to keep an eye on this, but this is longer term. Here's a daily chart of the CRB index, barely hanging on to an uptrend here, but still it's an uptrend nonetheless. And then the Baltic Dry Index is now crossing over to a downtrend. So according to this chart, to ship products through the Baltics, usually this goes up when it costs more. It's actually coming down and starting to look a little more negative. So that's not inflationary there. Inflation expectations kind of topped out to where we were at the beginning of 2025 and seem to be well within this range. Then we look at a ratio between inflation expectations and tips, which do adjust for inflation and interest rates, kind of coming down overall. So when this is going down, that means the tips are actually outperforming a little bit there. But then I have some other ratios that I show in other videos and later on, and it doesn't seem to be that inflation is a real problem right now. Then we look at aluminum, which is still in a downtrend, even though it's bouncing back up. It was down over 1% in Thursday's session. Corn continues to be in a downtrend here. Wheat is in an overall downtrend. Fertilizer going up a little bit here, but not really breaking out and causing too much concern there. Lumber hanging on to a pretty weak uptrend right now. Then oil, which is in a downtrend. It spiked up when the whole Israel-Iran event, I guess if you want to call it that, happened. And then it immediately came back down when it looked like Israel was taking care of things. Then the U.S. came in and took care of things. And we're still in the mid 60s. We're still in a downtrend, but it did really spike up. But now it's coming back down. And the gold to oil ratio, gold has been pretty much going sideways. Oil has not really been doing all that much. But we see where gold, when it has a down day, that tends to push this ratio down. And then we've been just kind of stabilizing right now with this overall ratio. Then we look at the correlation between oil, the red dashed line, which is bouncing back up a little bit, and then the 10-year yield here. And then the correlation is still pretty strong between both of these charts, looking at oil and the 10-year yield. They tend to go in the same direction at the same time. Heating oil is trying to get into an uptrend. It spiked up, but now has been pulling back. It's still in a downtrend, though. And then gas, which is in a little bit of an uptrend right now. Of course, these are the summer months when people are traveling, and it's not uncommon to see gas prices go up. Natural gas still in a downtrend here, been pretty much going sideways lately, but still in a downtrend. And we did see a spike up in diesel, and now that's starting to come back down as well. All right, copper, this looks good for the economy. Looking pretty good, not setting all-time highs here. It was down over 1% in Thursday's session, but the uptrend is still well intact. It might have fallen back a little bit. You would think copper would go up because the employment report ended up being stronger than expected, but it could also be some profit taking that was going on as well. And the copper to gold ratio, it really spiked up, but still overall copper is underperforming gold. Longer term, look at the ratio, copper to gold ratio going down. We're going sideways to slightly lower here with the 10-year and 2-year yield. Gold just kind of chopping along sideways. It'll go down a little bit, then it'll have a pretty good up day, then it'll go down again. It's not really trending right now, but longer term, it's still in an uptrend dealing with its 50-day moving average. Silver kind of chopping along above its 50-day moving average. And we look at the gold to silver ratio on top. When this is going down, that means silver is outperforming. And then we look at the dollar, and we're getting more into that neutral area. We're not really getting a lot of insight from the gold to silver ratio compared to the dollar index right now. But the dollar just continues to be weaker. And yes, there's some speculation out there that this is being done on purpose to help the stock market go up because the stock market likes a weaker dollar. But at some point, we'll probably get very oversold with the dollar and then see some kind of a bounce with that. And then what's that going to do to the stock market if dollar strength starts to come back in? And here's the euro, which is just really going up compared to the dollar as it's going down. The Japanese yen still in an uptrend, but just kind of going along sideways where the euro has been a lot stronger. So here is the euro. And as I took the charts here, you can see that the market's actually open because of the holiday. Some markets are open, but American markets are closed. But the euro is pretty strong compared to the dollar. Japanese yen still in an uptrend, but really going sideways lately compared to the dollar. And the British pound is in an uptrend compared to the dollar, and that hasn't changed. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we are seeing some improvements here. When both the red line and the bar chart are going up, that's positive. When the bar chart is above the red line, that just means that the equal weight version of the S&P is outperforming. But we're seeing the lines get a little closer to each other. Yes, they are on different scales, but we try to match them up. This is showing a little bit more broad market participation coming in. And just kind of chopping around, but for the most part, we still are declining with the equal weight underperforming the S&P, but it is improving. And then this is where we are seeing a bit of a change. Stocks to commodities, we're starting to see a golden cross where stocks are now back to outperforming commodities. We're seeing a death cross here showing how commodities are now starting to underperform stocks. The NASDAQ 100 is outperforming the S&P, even though both are setting new all-time highs. This is a healthy sign. We like to see the NASDAQ 100 outperforming. And the S&P 100 continues to outperform the S&P 500. That's also positive for the market. The NASDAQ is outperforming the S&P 500, recent golden cross here. And the NASDAQ 100 is underperforming the NASDAQ. And this could be taken as negative. It's like, well, where are the big stocks? How come they're not really leading the charge? They are, but there are stocks in the NASDAQ that are actually leading even more right now. And this just shows more broader participation. But this is still in an uptrend overall with the NASDAQ 100 in an uptrend compared to the NASDAQ. Mega caps are still outperforming the equal weight version of the S&P. Mega cap growth setting a new all-time high, recent golden cross, looking pretty solid there. Small caps, even though they were up here, they've got a lot of damage to repair to get back into an uptrend compared to the S&P. And the red line, this is the small cap to S&P ratio. This is the blue line is the S&P 500, just setting new all-time highs. Small caps still continue to underperform the tech sector. And robotics and AI ETF doing okay. coming out, breaking above the rainbow, and but not really underperforming, or it's continuing to underperform when compared to the tech sector. Even though the tech sector is doing well, the robotics and AI ETF is doing okay, the tech sector is doing even better. And the Dow Jones Composite still in a downtrend, but improving. The transports are seeing a little bit of strength. Utilities tend to drift sideways to higher, and the Dow is showing some improvement. So we're still in a downtrend here, but this has really come up with the overall average. And then semi to tech, this is what we want to see when we're more positive on the market. Now, the market is very overextended right now. It seemed like any news that hit the market this past week, actually the last couple of weeks, anything was taken as good news. Excuse me. Even if it was bad news, it was taken as good news. And that's when we're showing with our sentiment indicators that we're getting pretty extreme right now. If we do see some kind of a pullback or at least sideways movement as we move more throughout July, which is seasonally positive, the first half anyway, we're going to be watching this ratio to see what happens here. Is this going to hold up and keep going up if stocks go sideways to down? If we continue to go up, is this ratio also going to continue to go up? And that's more positive for the market. Low volatility ETF continuing to go sideways, just hanging on to a slight uptrend there, but really underperforming and actually starting to see a death cross here with this ratio when we compare low volatility stocks to the S&P. Our world still looking a lot stronger. The US is improving, but it hasn't come back and really taken a leadership role lately. But we're looking really good here with the all world stocks. When you take out US stocks, you put US stocks back into the mix, it's going up, but underperforming. And energy sector really underperforming the tech sector. And growth is outperforming bonds. That's setting a new high here with this ratio. The tech sector starting to outperform. We're seeing a golden cross here when compared to the 10-year yield. Starting to see a death cross here with the 10-year underperforming the tech sector, and that's more positive. Discretionary improving. We're still hanging out above the 200-day moving average, and it's looking better, but we'd like to see this ratio continue to go up and be even more positive. Staples are underperforming discretionary, but not quite in a downtrend yet. Gold still underperforming the S&P as gold has been going sideways. The S&P mostly has been going up. And when that happens, this ratio goes down. And then the dollar's been going down and gold has been going sideways. So we really haven't seen much of a change with the gold to dollar ratio. Then the advanced decline line's looking pretty good. We're going up, setting all-time highs with the NYSE common stock, the S&P, the mid caps. Small caps are trying to break out, but have a ways to go to get back to an all-time high here. But there is some improvement happening. And we're not quite back to an all-time high with the Dow. And we're still in a downtrend with the Dow. The transports are improving, but they've got a long ways to go to get back to previous highs. And this is what I'm talking about with the utilities. Sideways to higher. Just they're positive, but they've been starting to underperform the more growth-oriented areas of the market. And we're actually coming down a little bit with the Dow to transports ratio. And this is coming down. That means the transports are outperforming. Here are the transports, which are improving and looking pretty good, but they've got some resistance areas to try to get above. And then can we even make it back to this previous all-time high and then the other all-time high that was set back in 2024? And the transports are improving, but still underperforming the S&P 500 longer term, but the correlation still remains pretty high between the S&P and the Dow transports. And then the new look at Dow theory, setting a new all-time high with the S&P, setting a new all-time high with the NASDAQ. This, I pointed this out in the daily video, a little bit of a negative divergence. We'll be watching this. Back in February, when the S&P weighted index set an all-time high, the equal weight version did not. It actually produced a negative divergence before we went into that big decline in March and into April. We are improving and we're close, but we have not set an all-time high with the equal weight S&P, where we are now setting a new all-time high with the QQQ equal weight. So you could say this is positive because the Qs are leading the S&P, or you could switch this around and say this is negative, where the S&P has not made an all-time high, where the Qs have. FANG index, all-time high in an uptrend, big stocks there. We're seeing a golden cross here with the Wilshire 5000 and the total U.S. stock ETF, so broader The broader market measures that we look at are now turning back to positive and setting new highs. ARC is in an uptrend, both on the weekly side and here on the daily side as well, but it's got a long ways to go to get back to those previous highs. NYSE Composite, golden cross here, setting an all-time high. That's a broad market measure, looking more positive. High leverage loans, setting all-time highs here. This is also a good look for the economy going forward. All stocks, which are U.S. and international stocks, it's still the international stocks that are leading this higher, but the U.S. stocks are trying to show some improvement. Bitcoin still kind of floundering around a little bit below the 1,000 or 110,000 level there. It's just been kind of chopping along sideways recently. Microcaps still in a downtrend, but improving. If we stay above both moving averages, that could produce a golden cross. Emerging markets are in an uptrend. Japan chopping more or less sideways, right near this red line, which goes back to the 1989 highs that were set. And then semiconductors are improving. We're starting to see some golden crosses generated there. The SMH semiconductor setting a new all-time high, recent golden cross. Semiconductors here, the same ETF, but now breaking out further above the rainbow. The AI and tech ETF, just coming off of setting a new all-time high and a recent golden cross. Then we switch over to the home builders, and we're seeing the correlation between the two is pretty strong. The home builders are still negative, but they are trying to improve. And we're still more or less in a downtrend as measured by the KST in China, trying to turn up with emerging markets, trying to turn up in Europe, a little bit of a turn up here in Japan, but still declining, and trying to turn up again here with the US. And this is longer term. And then another global look here of US stocks versus global stocks, still above this moving average, and we're flattening out with the PPO, the momentum oscillator. Then here's the price of bonds where they had been going up as interest rates were going down. Now we've seen bonds start to retreat. We'll be watching the 4.5% level with the 10-year yield. Total bonds based on price, the ETF here still in an uptrend. And then we finished June, so the stock to bond monthly ratio is still looking pretty solid, setting a new all-time high as we head into July. Bonds are still underperforming stocks. Here on the daily chart, if you watch the weekly video, they're also underperforming on the weekly chart as well. Junk bonds just coming off of setting all-time highs. Corporate bonds are improving back into an uptrend now, but still a ways to go to get back to previous highs. The Pring World Bond Index is in an uptrend, but still very, very choppy as well, not really breaking out of the range. And the corporate bonds have now recently switched back over with the golden cross, and they are improving. And the stock to bond correlation, still pretty high. The price of stocks and the price of bonds are tending to go in the same direction at the same time. And then the riskier bonds, junk bonds versus more conservative bonds, still at the lower end of the rainbow here, but junk bonds by themselves have been really doing well. And we're still up in this higher range here with the 10-year yield going back to 1980. Junk bonds, as I said, just coming off of setting recent all-time highs. People want the yield. They're willing to assume that greater risk. And then the junk bond to government bond ratio continues to be in an uptrend. Here's a daily look where we were coming down with yields in the U.S. here, but both Wednesday and Thursday, they started to go back up. And we'll be watching that. That could put some pressure on stocks if these yields continue to go up. And then not much of a change here when we look at the weekly chart internationally across the U.S., U.K., Japan, and Germany. And the volatility still coming down with the MOVE index as bond prices were going back up. Now they've been going back down. But overall, the MOVE index is declining. The VIX is still under 20 right now. And we're coming down a little bit with the correlation, but they're still having a tendency for the volatility to be going in the same direction at the same time. Then we do some stock to bond ratios here, setting a new high with the S&P to short-term bonds. That's positive. And then the S&P 1500 to short-term bonds also looking positive here. Another broad market measure with 3 to 7 year bonds, not quite back to the all-time high yet, but still looking positive. The tech sector setting a high when compared to 3 to 7 year bonds with the ratio. And then the S&P stocks to the 10-year yield, just about ready to generate a golden cross here. And then this is an inverse where we're showing how bonds are underperforming the S&P 500, and that's more positive. That means the S&P 500 is outperforming. And then a long-term look at the 30-year price, still declining, still below the moving average, which is going down. And then we have a long-term ratio of the long-term bond to commodities that's continuing to decline. When we look at the sectors, we have seen materials actually bouncing back and doing a little bit better. Still in a downtrend, but back above their not only 50, but 200-day moving average, but still in a downtrend when compared to the S&P. Communication, a big growth area, didn't have a great week, but was up nonetheless. This is coming off of just setting recent all-time highs and still doing quite well. It's starting to level off a little bit here with the ratio to the S&P as the rest of the S&P has been improving, but this is still a pretty solid uptrend, and we like that. That's more positive. Then energy, which has kind of been all over the place here. It shot up, then it came back down. Still in a downtrend, still dealing with its 200-day moving average, and still in a downtrend when compared to the S&P. Financials, setting an all-time high with the sector. That's good. We want this to do well. And I say that every time. This can sometimes give us some clues if there are some problems. Now, a week ago, there was a stress test that was done on the big banks. Now, there's the debate going back and forth. Does it really test what it's supposed to test? But all the banks that were tested passed the test. And since that time, the financial sector has been seeing some more improvement. And it came down to the 200-day moving average with the ratio with the S&P. I've been showing this in the daily video. So far, we've been showing an improvement with this overall ratio. Industrials, recent golden cross, looking pretty good here. And actually one of the better performing areas, even though kind of going sideways here with the ratio to the S&P. Tech sector, all-time high, recent golden cross, and one of the stronger areas with the ratio here, after also generating a recent golden cross with the ratio. Staples pretty much going sideways. They did get a little bit of an upthrust as we started the new quarter and the new month. They're still in an uptrend, but they're not really showing any leadership role right now. And they're underperforming, and soon we could see a death cross here with the Staples to S&P 500 ratio. Real estate just kind of bouncing along, still in a downtrend, but hanging out above its 200-day moving average recently, but underperforming when we compare it to the S&P. Utilities drifting higher for the most part here, not falling apart, but not showing any real strength right now either. And this tends to be more defensive, but you could also put this into the growth category because there's so much need for electricity going forward with AI and with the EVs and different areas that as the economy tries to shift over. And utilities are underperforming the S&P, still in an uptrend, but the more this goes down, the more we might see a golden cross in the near future. And the S&P, excuse me, has been outperforming the utilities, so we're seeing this ratio going back up. That's more positive. Healthcare just really struggling in a downtrend, dealing with its 50-day moving average and really underperforming the S&P on a ratio basis. Discretionary, we're just about ready to see a golden cross with the discretionary sector. That could be positive. We've been treading along sideways, but we spent most of the time above these moving averages. That allowed the 50-day moving average to start to come back up. So this would be more positive, but we're still not really outperforming when we do a ratio between discretionary and the S&P 500. Semiconductors getting really close to a golden cross with the SOX ETF here. And so this is improving, but still a ways to go to get back to its all-time high. And then the Dow Jones Semiconductors, recent golden cross, setting a new all-time high with this index. Longer term, still looking good with the 200-week moving average continuing to go up. The semis growth to Dow value ratio continues to improve. We finally broke this series of lower highs, and we're getting up closer to the blue line now. InterMarket analysis still shows gold holding on to the most gains in 2025. Now stocks are in second place. Then we have commodities in third place. That's the purple line. The dark blue line, those are bonds based on price. And the red line is oil, with the dollar still being the weakest. Correlations, opposite directions when we compare the dollar with the S&P 500. And lately, the S&P has been going up, the dollar's been going down, and that's why we're seeing an opposite correlation right now. Just coming off of being extreme in opposite directions when we look at the S&P to oil correlation here. And then the S&P to 10-year yield, they were going in opposite directions. Now we're starting to come back up more into the neutral area. The tech sector to the 10-year yield also, they were going in opposite directions. Now this ratio has been turning a little bit stronger as interest rates were going back up. And we're also going back up here with the S&P to 2-year yield. Then some long-term looks here. This is a monthly chart of the NYSE. We still are holding out above this long-term moving average. We're still going down with the Copic curve. It's trying to turn up a little bit, but this is a long-term chart, so it may take a while for that to improve. Another monthly chart looking good here with the NYSE. Still trying to go back up here with the NYSE record high percent index. That's a broad market measure. Then we look at a monthly chart of the S&P, still above the moving average and turning back up with the PPO. That's longer term positive. And then the S&P on top, and then a ratio between stocks and commodities. Stocks are still underperforming longer term. It's on the daily side where we're starting to see the S&P outperforming the commodity index, the CRB index. And then long-term global stocks still hanging out a little bit above the moving average, but the KST is still in a decline. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then we go through the positive areas. Pretty long list here. The value indexes have now been added to the positive side. Growth has been on here for a while. Copper is in an uptrend, as are all the currencies pretty much against the dollar. The CRB index, gold and silver are in uptrends. The low volatility ETF, even though it's going sideways, it's still in an uptrend. The mega caps are in an uptrend, tech's in an uptrend, semiconductors. We're improving here with the SOX index. We're not quite back to a golden cross, but the indexes and ETFs that we follow are showing golden crosses. Staples in an uptrend, but really underperforming the S&P. That's more positive for the market. And then bonds based on price are looking pretty positive across the board here. And now we have the NASDAQ 100. The NASDAQ is now in an uptrend. The NYSE is in an uptrend. And then new additions are the Wilshire 5000 and the total U.S. stock ETF. FANG index, big stocks in an uptrend there. ARK is in an uptrend. High leverage loans, again, good for the economy there. Emerging markets are in an uptrend. All stocks are in an uptrend. And Bitcoin is in an uptrend. Then the list is getting pretty short here on the negative side, with the dollar still being down. The Dow Jones Composite, it's improving. It's above both moving averages, but it hasn't generated a golden cross yet. And then the Dow is still in a downtrend. Mid caps, small caps have a ways to go, and the micro caps. Even though all of these are improving, they haven't generated positive trends yet. Thank you. I hope you're having a wonderful holiday weekend, and I will talk to you in the next video.